So it looks like natural gas is finally broken down. It's in a pretty tight range for a while. So let's take a look at that and figure out how we can make some money off of it. So here's natural gas. This goes back 2 years. And this is what we call market memory. This black line here is the $2.40 level. So we could see 2 years ago, it was a support level. Support is a level where there is more demand than there is supply. So when a market's heading lower, it's because there's not enough demand or buy orders to absorb all of the supply or sell orders. So the sellers are forced to offer out whatever it is that they're selling, in this case, natural gas, but it applies to all financial markets at a discount. So we got down here and we found support at the same exact level 2 years later. This is what we call market memory. A lot of times an important support or resistance level can retain its importance for a long time. It could be months or even years. So let's take a closer look, but I just wanted you to see that, right? So we're back to where we were at the end of 2020 after being all the way up to almost $10 just a few months ago, 6 months ago. All right, let's take a closer look. So this is just a close up. This is just for the past 3 months. And when a support level gets broken, meaning that the price goes below it, we it's not just symbolic. It tells us something. And all charts should be looked at in the prism of supply and demand. It tells us that the investors who created the support with their buy orders are gone. They've either left the market or they cancel their orders, but regardless, they're out of the way. So whenever you have a market and you take demand out of it, it sets the stage for it to go higher because sorry, let me say that right. Whenever you take demand out of a market, it sets the stage for the prices to move lower because less demand, supply needs to push the prices down to get their orders off. So it's just basic economics. The top of the range here is what we call resistance level. So this is the opposite of support. There's more supply than demand. So when the market's going higher, it's because the buyers can't fill all their orders. So they have to pay a premium. When we get to resistance, that changes. There's enough supply or sell orders there for them to buy all they want. So now we got to keep an eye on this. A lot of times, levels that were support can convert into resistance. And this could happen because of buyer's remorse. There could be a number of buyers in here who regret buying now that the price is lower. And a lot of them will tell themselves, hey, I made a mistake. I want to get out of this, but I'm only going to do so if I can get out at break even. So they place their sell orders at the same level they had their buy orders at. And if there's enough of these sell orders being placed by remorseful buyers, the level that was support can turn into resistance. So you might not be a futures trader, but there is a way to profit off of this in the ETF market. And pretty much most commodities there's an ETF that's designed to track them. Now this is an ETF that is designed to move 2x inversely to natural gas. So in other words, natural gas goes down 2%. This should be up by about 4%. Look how much it's up since just December. We went from $12 up to 71. So one of the things that I like to talk about is all these different ETFs because a lot of people don't even know that they exist. So here's a way that you can make money if natural gas continues to go lower in the equity markets. It's just a basic ETF. It just trades just like a stock. All right, so that's it. Just something to watch going forward. Thanks, everybody. See you soon.